Gold ran to a record area near 5,595 per ounce, then dropped close to 9% at the low, roughly a $500 air pocket from the peak. Silver did what silver does when it's overheated. It cleared a psychological level above 120, then snapped down into the 107 zone. A brutal double-digit fall in a single session. And if you were holding paper exposure, you felt it instantly. The most liquid vehicles don't drip down during stress. They gap down because everyone hits the same sell button at the same time. Now, you've probably seen the headline number, a $6 trillion exit. Don't get hypnotized by the exact figure. Focus on what it represents. A fast, synchronized valuation reset across metals plus the paper layers built on top of them. Here's the simple logic. Gold is a multi-trillion-dollar asset class because the estimated value of above-ground gold is enormous. A near 9% peak-to-trough swing applied across that stock can translate into trillions of paper value repricing. Silver is smaller, but it's far more leveraged in sentiment and derivatives, so the percentage move can be even more violent. Then add the fact that big funds often sell liquid hedges when something else blows up, and you get a cross-market flush that feels like a mass exit. So the question is simple. Why is the exit accelerating? The three engines. Why selling speeds up? This move has three engines, and today, all three are firing together. Engine 1. Policy repricing. Over the last day, markets began pricing a more restrictive path ahead, higher for longer vibes, tighter liquidity, firmer real rates. You don't need certainty, you only need a shift in expectations. When that happens, the dollar rebounds. And when the dollar rebounds, dollar-priced metals become harder to chase, especially for leveraged longs. That's the first squeeze. Engine 2. Tech liquidation and the ATM hedge. The second engine is cross-asset deleveraging. A major tech shock hits portfolios. Collateral gets marked down. Margin requirements rise. Risk managers start calling. Here's the ugly truth. Funds don't sell what they love. They sell what they can. Gold and silver futures are liquid. Big ETFs are liquid. They become the ATM. So you get the paradox. Metals were the winner, and winners get sold to patch the hole somewhere else. Engine 3. Fear premium dissolving. The third engine is the safe haven premium leaking out. When fear is high, money piles into metals, just in case. When credible reports hint at cooler temperatures and possible talks, that fear premium can evaporate faster than it arrived. And when the fear premium exits at the same time as forced selling, you get a vacuum. Why silver feels like a car crash? Let me say this plainly. Silver is not gold with a different color. Silver is the market's emotional amplifier. When silver gets hot, it attracts fast money because the moves are bigger. That same fast money uses leverage, tight stops, and momentum signals. So when the trend breaks, the exits are narrow. That's why you can see up 60% on the month and down 12% today in the same sentence. Silver doesn't glide. Silver whips. And there's another layer, paper exposure. ETFs and futures don't care about your long-term thesis. They care about flows and risk limits. In stress, they become a pressure valve. If enough people rush out at once, the vehicle moves like a stock, fast, mechanical, emotionless. Manipulation or liquidity vacuum. Now I know what you're seeing online. This has to be rigged. Trillions don't vanish in minutes. Here's a cleaner explanation that matches how modern markets actually trade. A liquidity vacuum happens when volatility spikes and the normal bids step aside. Market makers widen spreads. Dealers pull resting buy orders. Not because they're evil, because they can't price risk fast enough. That means price doesn't fall through a staircase. It falls through a trapdoor. Here's the chain reaction. 1. Price drops fast. Volatility explodes. 2. Volatility explodes. Spreads widen and bids thin out. 3. Thin bids. Stops trigger. 4. Stops trigger. Liquidations fire. 5. Liquidations fire. More selling hits fewer bids. 6. Fewer bids. Price falls until it hits a new pocket of demand. That's why the chart looks impossible. It's not impossible. It's thin. Crash or correction. Two things can be true at once. 1. The move is violent. 2. The larger trend can still be intact. In overheated markets, the first big flush is often a cleansing event, but only if structure holds. And yes, before this drop, silver was stretched. When an asset is trading far above its recent comfort zone, it doesn't need a villain to fall. It only needs gravity plus leverage. So don't argue the label, track the levels that matter. What I'm watching. Gold. The first battlefield is 5,050 down to 4,180. The psychological line is 5,000. If gold closes the week decisively below 5,000, the risk increases for the exit to accelerate toward the next zone near 4,800. If it holds above 5,000 and reclaims momentum, today becomes a violent shakeout, not a structural break. Silver. The first battlefield is 102 down to 98. If silver holds that zone and stabilizes, today becomes a shakeout. If it slices through and stays under it, you're looking at a deeper reset before the next leg. And if you're wondering why these zones matter, they're where buyers previously stepped in and where a lot of risk systems anchor. When those levels break, computers don't debate, they execute. What to do? Practical rules for days like this. Rule 1. Respect volatility. No hero trades. Rule 2. Separate investment from position. If you're stacking physical for a long thesis, a paper flush is not the same thing as supply changing. If you're trading leverage, a paper flush can end your account even if you were right on the direction. Rule 3. Watch the dollar and real rates. When those firm up, metals usually pay the price. Rule 4. Watch premiums and availability, not just spot. When spot falls but real-world premiums refuse to collapse, that's information. Now the big mistakes people make today, they sell the flush, then buy the bounce, twice. They average down with size instead of patience. They treat a headline number like a prophecy. They ignore position sizing. Here's the simple sizing rule that saves accounts. If a normal day is a 1% move and today is a 10% move, your size should be about 1/10, not the same. What would confirm a low? If you want a checklist, here it is. Selling slows, candles shrink. We stop making new lows every hour. Silver stabilizes above 98 to 102 and starts reclaiming levels instead of slipping. Gold defends the 4,980 to 5,050 zone and closes strong into the weekend. The dollar's rebound stalls instead of accelerating. Open interest comes down, meaning leverage is getting purged. If those show up, today starts looking like capitulation, not collapse. 2 scenarios for next week. Scenario A. Reset and resume. We base above support, volatility cools, and the market climbs again, slower, healthier, less euphoric. Scenario B. Cascade. Support fails, funds keep raising cash, and metals act like collateral, sold not because people hate them, but because they need liquidity. Your job is not to predict with ego. Your job is to respond with discipline. 60-second playbook. What I'd tell a friend. If you're staring at the screen right now, do this in order. First, stop using market orders. In a vacuum, market orders are donations. Use limit orders or don't touch it. Second, zoom out to the weekly chart. Intraday candles lie when liquidity is thin. Weekly closes tell the story. Third, decide what you are. Trader, swing, or holder. Don't mix identities in the middle of a storm. Fourth, keep a cash buffer. Forced sellers lose because they have no buffer. A buffer turns panic into options. Fifth, write 2 prices on paper, a buy zone and a stop zone. If you can't write them, you're not ready. And one more reality check. Blow-off tops often retrace fast. That doesn't invalidate the bigger thesis, but it does punish impatience. The market is clearing leverage. Let it. Also watch the quality of the bounce. A real bottom usually has heavy volume early, then selling exhaustion, then higher lows. A fake bounce is thin and fades the moment the dollar ticks up. If you track physical, call 1 dealer or check 2 online listings. If availability stays tight and premiums stay stubborn while spot dumps, that's a clue that paper selling is leading, not real-world dumping. And please, don't let one day rewrite your entire plan. Let the close decide. Final note, if you're leveraged, reduce first, analyze second. Survive the volatility, and you'll have plenty of chances. Get shaken out today, and the next rally won't matter to you. That's the whole game. Period. Look, days like this are designed to make you emotional. Your job is to become boring. If you want my next update, subscribe. I'll post what changed after the weekly close, and I'll tell you which level mattered most. Comment one word, buy, hedge, or wait, and tell me what price you're watching. Stay safe, stay small, stay patient,